Hi everyone, welcome back to this CashCalc training series. We've covered off quite a bit already. We started off by explaining how to just build a client into the system and then explored the settings tabs and discussed how those different settings impact different parts of the system. Then we spoke about actually how to fill the client with all of their data, whether you're bringing that across from a third-party integration partner of ours or whether you're using the client portal in CashCalc or whether you're just manually putting that in. Then we discussed in the last video how to take all this data and then push that into that cash flow model and all the layers of complexity you can add on top of that as well. And this last part of the training series will be to discuss the different tax calculators of ours. They'll all live under this tools tab so long as you've selected a client, you're under the client pages. Before I dive into that though, it's worth pointing out under that info tab, you've got this little button here. Now we've clicked on this a couple of times during this training series, and I've always used this to take the data and just push it directly into a cash flow, which is pretty neat. But equally, just bear in mind, and we will come back to this at stages during these last couple of videos, just to explain how you can actually take that data and not necessarily throw it into a cash flow model, but actually push it directly into a calculator without having to go to that tools tab. Particularly useful, for example, our IHT calculator. Also gives me a bit of an excuse just to quickly mention these two features as well. I think we discussed the letters of authority on the first video, but it's linked there as well. So if you click on that, it gives you a nice letter of authority for the client of their pots that you need, and equally all the company detail and data that you have stored on CashCalc. And you've also got a net worth statement that you can print off whenever you like. Again, if you spent some time aggregating all of that client data into CashCalc and the system therefore knows all the pots and how much they're worth and the incomes and expenses, it's a nice little touch. You can click on that button and get a nice wealth statement that you can then push back to the client on the portal or print off and give to them directly. So there's a couple of extra little features, but without further ado, if you click on the tools tab at any time, it loads up all of these calculators we have in the background, and I'll endeavor to go through each one here. The first one is the easiest because that's just our cash flow modeler. So if you click on that, it's just basically another button, and just clicking that. So it's just a duplicate, so we won't bother going through that again. That was the last video. But the first calculator we'll go through is level versus indexed annuity. So I'll click on that and load it up. And it's a really simple tool that allows you to compare the differences that you're getting in terms of the rates you're getting between a level annuity and an indexed annuity. So if you've just received a quote for your client, say for example this Keith Baker, they're suggesting they can give us 45,000 a year for our level, to 27,000 for the indexed, and I judge inflation will be running maybe at 2.5%. Over the coming years, it shows me when that crossover will occur. So every single year we'll get 45,000 with our level, 27,000 with our index growing at 2.5, and it will take well over 20 years for that crossover to occur, where it's more lucrative to be holding the indexed annuity. There are two different ways of looking at that, though. This is just almost like on an absolute basis, just year on year. Clearly, if you add all that together, you get a cumulative look and feel instead. So you can toggle over here, and the cumulative shows actually that crossover rate is more like 40 years. It's a bit of a no-brainer. You're much better off to hold the level over the indexed, but that is given that it's 2.5%, and obviously the index will massively, the indexed annuity will massively change depending on what inflation is. So again, you can kind of use this as a bit of an education tool to kind of show clients, how these graphs differ. And obviously, there's no way of knowing what inflation is going to do, but at least the client would then understand that this is very much based on what inflation does in the future. And clearly, whether you do cumulative or standard, that crossover will happen sooner if inflation's running pretty hot. And in this case, it's now only, say, 11 years. And once you're ready to create a report, maybe push that back onto the portal, just click on create a report on the top right, PDF, and that gives me 3 or 4 pages, starting off with a little cover page. Then it shows me the two different scenarios, as in kind of cumulative and absolute, and then a year-on-year breakdown at the very bottom. So that's our annuity calculator. Back to tools. So the next one is our early retirement calculator, and in simplicity, it's quite similar in a way to the annuity calculator, where on the left-hand side, you've got some basic input fields, and then it will create a very similar graphic to what we had a second ago, and then the option again, looking at standard or cumulative. And the idea is just really trying to show the client the amount they could earn in retirement if they defer taking that income for X amount of years. So you can tell the system, if the client started drawing down or taking an income as of today, it would be maybe receive 40,000 a year. If they defer it for however many years, say 5 years, they would receive 55,000 a year. Input the inflation rate and save, and then it will create that graphic, show you when that crossover is. Obviously, the standard's pretty simple, but if you click on cumulative again, it kind of adds that all together and shows you that to defer it for 5 years, or to receive an income and defer it for 5 years and get a slightly higher level of income, it would take 16, 17 years to cross over and again be more lucrative to defer. And then again, once I'm ready to create a report, click on that blue button and send that across to the client. Next one is our pension drawdown tax payable calculator. And it's a calculator that basically gives you two bits of information. How much tax would you pay if you draw down the client's pension in one hit today? And how much would you pay in tax if you drew down over a number of years in the most tax efficient way possible? And again, simple input screens on the left. You tell the system how much the client's pension's worth. Have they been crystallized or not? What's the investment growth rate we're going to be using? So I'm going to be using 4%. How much is there? What taxable income is there in the background that the client's earning? Are we using Scottish tax rates? And the moment you hit save and calculate, all these figures will automatically adjust. And you've got the two calculations. So one at the top says, okay, well, if you were to take the entire pension, it's in entirety today, there's the amount you pay in the different tax rates. In total, that's how much tax you'll pay, and therefore that's the lump sum you'll receive at the very end. However, if you're willing to take it in installments, the most tax efficient way possible would be to draw down that much every year. It will take 14 years to take out the entire pot by avoiding that 40% tax bracket. That's how much tax you'll pay overall, which is obviously significantly less than taking the whole lot now. Obviously, because it's growing at 4% in the background, you'll end up with that much in its entirety at the very end of it. And then underneath some nice little graphics that show kind of the year-on-year reduction of that pension over that 14 years and what that looks like until you've exhausted and pulled the entire pension pot out. So that's our pension drawdown tax payable calculator. Back to tools. And let's have a look at pension drawdown calculator. Variable income, another simple one. It's essentially a very, very simple cash flow tool where it first of all expects you to type in a specific pension pot, then what's the assumed investment return, what inflation rate is going to be, and then obviously it calculates the real rate of return, and then click on save and calculate, and it will then compute and show you the graphics of what that looks like. But then you can start adding your different drawdown income. So on my current scenario, my client starts at 68, and from 68 to 73, I want the cash flow to mimic them taking £45,000 worth of income, again inflating at 2.5%. From 73 to 80, they're going to take slightly less, 27.5, and then from 80 to 100, they're only going to take 12.5. And again, I can adjust and delete these very quickly, or if I wanted to add another rate, I can just click on add drawdown income. You tell it the amount of income they're going to be taking a year, the start and end date, how you want to escalate that in terms of inflation, and then add. And it just gives you a really simple cash flow chart at the very bottom there saying, well, this particular pension pot, client obviously doesn't retire until this stage, but it's going to inflate a bit, and then we're going to start taking quite a heavy amount of income, and then it's going to slowly come down a bit, and then finally by the time they're 100, it's going to be worth 98,000, and there's the year-on-year figures at the very bottom. So again, a very, very, very simple cash flow chart, and again, click on create report if you want to send that across to the client. Let's go back to tools. So next up is emergency tax month one calculator. It essentially shows you the difference in the amount of tax your client will probably pay on that month one basis compared to how much they should have paid when they're withdrawing from their pension, a lump sum. So on the left hand side, there's only really a couple of inputs you need to put in here. How much is the lump sum that client's withdrawing from a pension? Is it fully crystallized? And what's the income they're making in the background? What tax year are we looking at? And are we applying Scottish tax rates? And if you click on save and calculate, it gives you those two boxes. Okay, on a month one basis, it's going to assume that this is how much you're going to pay in, or how much your client is going to pay in tax. However, the real amount they should have paid is exactly 34,000, given the amount of income they're earning in the background, and therefore the difference in tax liability is the difference between that number and that number. So pretty simple. So back to tools. Pension forecast calculator is next. It's a bit like a goal-based planning tool. So on the left-hand side, there's a number of assumptions that then impact these 3 different goals we can have a look at. So you start off by saying, okay, what's the pot size? What's the pension pot? It's 250,000 for this client. We're going to assume that grows at 4% over the coming years, and we're going to assume an inflation rate of 2.5, which gives us a real rate of return of 1.5. The withdrawal rate is that kind of golden 4%. We'll stick to that. And the desired retirement age is going to be 66, which in this case for the client is 7 years from now, and you save those assumptions, and then you can work through these different goals. So the first one, you can say, okay, well, let's take a look at making a specific monthly pension contribution until retirement. So if the client continues to save £500 a month every month, Save and Calculate, you've got the figures down at the very bottom that shows on £500 every month until retirement. That's how much the target so that's how much the target pension size will be worth, 431. That's how much income you'll get every month with that 4% drawdown, 1,440 every month, and that will last 32 years. Equally, what about if we wanted to reach a particular size pot? So at the moment that's going to reach 431, but actually we want it to reach 500,000. What does the client need to do for it to achieve that? Well, they need to start paying in 1277 every month. That will reach our desired target. And again, if we're withdrawing 4% a year, that will allow us to withdraw, my client to withdraw 1667 every month, and that will last 32 years. And lastly, what about if they wanted to be able to draw a specific pension income at retirement? So my client wants to withdraw £2,000 every month, not 1667, and they want that to last at least 30 years. So if you click on calculate again, that shifts everything around. Okay, your desired income can be met, £2,000 every month, but it means you're going to have to input that much every month. And that's the target pension pot you'll have to get to withdraw £2,000 every month to last 30 years. So as I said, kind of goals based, 3 different goals, set the assumptions, and again, create the report at the end. Let's go back to tools. Pension carry forward calculator. This is probably one of the most popular calculators we have. It allows advisors very quickly to calculate the amount of allowance their clients still have when it comes to pension carry forward, but equally it allows them to very quickly illustrate and educate their clients in terms of how pension carry forward works, and again why bits of advice are being given. So start off on the left hand side and tell the system what income your clients had this year. So in this case, my client's got a £85,000 pensionable salary. There's no self-employed profits or other taxable income. And we'll just start there. I won't add any pension contributions in yet. So allowance starts off at 180 because they've got their 60,000 this year and 3 lots of 40. And if you scroll down to the bottom, it shows those allowances on a nice bar chart. So almost like buckets. You got your 60,000 still intact, Mr. or Mrs. Client. You got 3 lots of 40,000 not being used. And we can then start adding some color to this and bringing it to life. So on the left hand side, you can start adding in some pension contributions for this tax year. So the client's made 3,500 of salary sacrifice, and maybe their employer matched it 3.5. And if I save that, 7,000's gone in. You can see straight away the allowance has dropped to 173. Table looks a little bit more interesting now. You can see that this tax year the client's made £7,000 contribution against that allowance of 60. Therefore, they've got 53 left. And if we scroll down to the graphic, you can see again like a bucket that's slowly being filled up now, and that kind of unused allowance is slowly being eaten away. You can then start adding the previous tax years as well. So if you scroll up to the top here, I can say, well, actually, last year the client made 7,000 contribution into that, maybe 11,000 the year before that, maybe 6,000 the year before that. Now, system in terms of pension carry forward only really cares about the last 3 tax years, but you can add the other taxes if you want. It will just add the contributions given on each one of the tax years beforehand. It just obviously won't have any bearing on the allowance your client has now. But if I click on Save Calculate, you can see that the last 3 tax years have now been taken into account. The allowance has dropped now to 149, and again looks a bit more interesting. You can see those pension contributions filling up each one of these buckets, and that allowance is slowly being eroded. Now, if your client, for whatever reason, in past tax years maybe earned quite a lot of money and their allowance was actually reduced because of tapering, so it's not 40,000 actually for this particular tax year, their allowance was only 10,000 because they earned so much in that year. On at the very top here on the right hand side, this is what this is: available allowances. So at the moment it automatically assumes that your client has the full allowance on every year, but I can then locate the year in question and say, well, actually no, because of tapering the allowance was reduced to 10,000. And if I add that in, if you scroll down to the bottom there, you can see it's basically controlled the amount of allowance you have or the client has, and they've already used 6 of it. They've only got 4 left, so 10 in total. For the purpose of this, I'll just remove that. So maybe your client has received inheritance, maybe through their job they've got a bonus, or through other investments they just want to simply, or you're proposing they should put more money into their pension. So if I start adding maybe a contribution in here, maybe the client's put in, or I'm suggesting they put another 50,000. So you can see reduces down to 99, and already kind of we're nearly at the limit this year. So it's going to spill over and start filling up my past years, and therefore using that carry forward. So let's just whack that up maybe to 100. Save. See now how the kind of color scheme works. Starting to fill in past years. Still got a bit more. I'm just going to go a bit OTT. Let's go up to 155. There we go. It automatically tells you you've gone over the allowance by 6,000. There's clearly going to be a charge levied on it. And scrolling down, it'll actually show you graphically that you've gone over by that 6,000. So I'm just going to remove that. Let's go back down to 149. I should do it. That's my suggestion to the client. Put in that 149,000, and then you get that nice little graphic just showing the client how they've utilized their current allowance, but equally how they've managed to utilize those 3 pots historically, and therefore none of that's gone to waste. And finally, nice little report you can create off the back of that. Little cover page. Then it goes on to a bit of a blurb in terms of what pension carry forward is. Then the inputs, the assumptions that we've made in terms of the pension contributions this year and the last few years. Then that obviously generates the table, which equally powers that chart underneath. Again, PDF that, put that onto the portal, back to the client. So that's the pension carry forward calculator. I'm sure a lot of people have used a mortgage calculator before, so this one doesn't really need too much of an introduction, although this has got an equity release feature in it as well. But ultimately, on the left-hand side, you start off with a start date, how much is being borrowed, in this case 350, what's the interest rate, what's the investment term, are there any extra monthly repayments being made on top of that? And if you click on Save and Calculate, it will tell you the monthly amount being paid, what the interest-only portion of that is, how much interest accumulates over the course of that term and policy, and also the total cost of the mortgage, including the amount borrowed. Now, you've got the option of flipping between monthly and annual payments. Obviously, monthly 15-year term, this will give you 180 rows of data. You can just flip that to annual to see year by year over the next 15 years how that slowly pays down the mortgage. On the left-hand side, you've also got the ability to very quickly flip that into an interest-only calculation. So you can see if it's interest only, okay, there's the interest only payment you make every month. There's the total interest charged again over that term, and including that amount borrowed, that's how much the mortgage is worth over that 15-year term. Equally, you can do part interest only, part repayment mortgage. So you can add the amount of interest only amount into that and recalculate. And in terms of equity release, you've got roll up interest as well. So again, the client just about to go through equity release. They're borrowing 350,000, 4% interest rate, 15-year investment term, and it works out how much interest is being rolled up each year. So again, how much you're going to be paying in interest, total interest charges. So that's yearly total interest charges over the course of that 15-year term, and rolled up year on year at the very end of that term. It means that including the amount borrowed, that client's going to have a final balance of 637,000. So the life insurance and critical illness cover calculator, it just basically adds up the cover needed to provide the level of insurance your clients need for both loans and protecting their family. So on the left-hand side, you start off by telling the system how much of a mortgage is needed to be covered. In this case, it's on a joint basis. And the type of cover needed is not just on death, but also for critical illness. Also, there's a loan outstanding, £20,000 loan that also needs to be covered by an insurance policy, again on death and critical illness. And we divide them into 2 parts. That's paid loans, but protect family are the others. So there's an income requirement as well. So again, on death or critical illness, the client requires a £2,000 a month income on a joint basis over the course of a 5-year period, and also another further lump sum of 40,000 held on a joint basis on the event of a death or critical illness. And finally, there's also childcare costs as well that they want covered, £12,000 a year over a 4-year spell. So again, another 48,000 on the event of a death or critical illness. And the moment you hit save and calculate at any stage, it just gives you a nice little box that just adds it all together for you to say, well, in terms of the loan part of that requirement, there's a liability there of 270,000. In terms of protecting family, it's 208. So in total, there's a liability there that needs covering via insurance of 478,000, again on a death and critical illness. But you can divvy them out. So on the left-hand side, maybe the loan section of this requirement is only really needed on a life insurance only basis. So if I click on save, that will divvy them out between life insurance only and life insurance and critical illness cover. And again, you can mess around with who needs what. So maybe for the monthly income, it's only really that's the requirement for Barbara, but on the lump sum, that's a requirement for Keith. And again, if you click on save, that will then divvy them out further. So as I said, this calculator is really just there to look at what the client needs, what type of insurance they need, and then summarize it neatly in that little box so that you can insure the client appropriately. The CGT calculator is probably one of the most widely used calculators on the system, and as the name suggests, it's just basically a calculator that works out the CGT liability for your client's assets. And it works from top to bottom. So the top, you add in all the assets, some assumptions midway down, and then underneath all of that, it will give you the calculation of the mass and the overall CGT liability. So to start off at the very top, to add an asset into the system, I've already got 4. Now, again, bear in mind, this can be fed from the info tab. So this is one of the calculators that feeds into that. So I can click on I won't do it now, but you can click on the info tab and use that little button to push all the assets directly into here rather than having to retype them. But to add an asset, it's pretty simple. You just click on the blue button, type in what the asset is, how much it costs to buy, how much the proceeds were when the client sold it, or if they are looking to sell it today. Is it a residential property? If it is, does it qualify for partial private residence relief? And if it does, you can type in the date of purchase, date of sale, and then also when the client actually lived in that property, and then it will work out in the background the tax relief as a result. Equally, if it's not a residential property, does it qualify for entrepreneurs relief or business asset disposal relief? And if it does, click on that, and again, the extra relief will be brought in the background and taken care of when it starts working out the CGT liability. So adding the assets is pretty simple. And then underneath that, what are the assumptions? Well, there's my client's pay. There's the CGT allowance available to him at the moment. There's the business asset disposal relief available. And then do we want to consider losses and expenses as well? So for the purpose of this, I'm going to say yes. If the client were to sell his house today, then there would be in here an extra £10,000 of losses or expenditure. Now you can see that it kind of divvies them out between the three: the main CGT assets, the property, the entrepreneurs relief, and the same again, these three. But this is kind of previous years, and this is the current. But the moment you hit save and calculate, scrolling down, it will work out again CGT to pay, and then that nice little tax table underneath showing you the main CGT assets equate to 22,000. The residential property tax on that is 15,000. So in total, 37. Obviously, there's nothing in terms of business asset disposal for this particular client. Now, if the client was married, if you scroll up a bit, that's what this is here for. I can say, yes, the client is married. I am going to suggest that he gifts this to his spouse, maybe 50%. And on the right-hand side, Barbara's data suddenly appears. I can tell the system how much she earns, what her allowance is, and again, if she's got any relief for entrepreneurs, and again, the ability to consider those extra expenses. But if I just click on save and calculate, it goes from 37 down to 33. And I can show at the very bottom why that is, because husband now owes, if all of those assets were sold, husband owes 16. Wife owes 16, and therefore in total it's 33. And then if I wanted to show that as a nice report, once again, I won't do this now, but click on the create report button, PDF it, and it gives the client a really nice statement of and shows them and illustrates their CGT liability if they were to sell these particular assets today. So like the mortgage calculator, I suspect a lot of people have used a salary calculator before, and this is no different other than it does create quite a nice report at the very end. So left to right, on the left-hand side, you start off by giving the assumptions to the system, telling it basic things like client pay, etc. And then on the right-hand side, it will work out very quickly how much that client takes home on an annual basis, monthly basis, etc. So on the left, pop in the client's pay, what their personal allowance is, any bonuses at play, whether they contribute towards a pension, both salary sacrifice and personal. So in this case, my client's making a 6% salary sacrifice into their pension. What tax year are we considering? You can do historic. What's the income frequency? So this is an annual amount, hence why I put annual, but you can work that out on the other frequencies. How many hours does that client work a week? And that allows us to work out the hourly pay over on the right. Is there a student loan plan in place? And if so, which one? Do you want to include dividends? So if so, how many dividends has the client taken? Is the client on a K tax band? If so, pop it in there. Do Scottish tax rates apply? Are they registered blind? If the client's retired and no longer paying any national insurance, and you can disable that or toggle it on and off. And the moment you hit save and calculate or work out the figures on the right-hand side, you can then work your way down the frequency, how much the client earns on an annual basis, monthly basis, weekly basis, all the way down to hourly. And if you ever click on show calculations, it will essentially show you how each one of these rows on the right is worked out. So their pension contributions is 5,000. How? Their taxable income was worked out to be 66,000. This is how. Again, their tax paid was 19,000. This is how that was worked out. And then they contribute 5,000 a year towards national insurance. And again, how was that worked out? And that was here. And at the very end, if you click on create report, PDF that, you get 3 or 4 pages, the first page being a cover page, then it goes on to introduce to the client what a salary calculator is, and then underneath that, kind of line by line of the client's salary and the tax they pay. So that's our salary calculator.